Imagine finding thousands of dollars you didn't even know you had just by understanding a few key rules. In a world, brimming with complex financial jargon, we're cutting through the noise today. We want to show you how strategic tax planning isn't just for the ultra wealthy, it's really for you. Get ready to transform your approach to your money and hopefully unlock some real tax savings. Welcome to the deep dive. Today, we're diving into, well, a treasure trove of insights on individual tax compliance and planning. Our mission for you, our listener, is to pull out the most impactful nuggets of knowledge on how to maximize your after-tax wealth. Putting more money right back into your pocket.
Exactly. And this deep dive, it's really all about empowering you with the tools to navigate your financial landscape more effectively. We're going to break down some pretty complex tax concepts, turning them into clear, actionable strategies. And we're focusing specifically on tangible ways to save, things you can actually implement in your own financial life.
Absolutely. And when we talk about maximizing after-tax wealth, a huge piece of that puzzle is understanding how your compensation beyond just your regular paycheck actually gets taxed.
Yeah.
This is a big area where, honestly, many people leave money on the table without even realizing it. We're talking about things like equity compensation awards. They've become incredibly common, right? Especially in growing companies,
Right.
from startups all the way up to established tech giants.
Yeah, very common. You'll see them in different forms.
Right. You hear about stock options, restricted stock, and stock appreciation rights, SARs, they often call them. And it is critically important to understand when and how these are taxed because, well, it's definitely not always straightforward.
Not at all.
Think of it like a journey for your stock award. There are several key milestones, you could say, or dates you really need to remember. First, there's the grant date. That's simply when your employer initially gives you the award.
Right, the starting point.
Then comes the vesting date. This is when you officially gain the right to, say, exercise the award because any restrictions like maybe needing to stay employed for a certain time finally lapse.
You've earned it, essentially.
Exactly. After that, you have the exercise date. That's when you actually use your options to buy the stock, or if it's something like a SAR, you cash out its value.
The trigger point for many tax events.
Then there's the sale date, which is pretty self-explanatory when you decide to sell the stock you've acquired. And finally, there's the expiration date. That's just the deadline. You have to exercise your rights by then, or poof, they disappear.
That's right. Knowing those dates is foundational. It really sets the stage. So let's start by unpacking non-statutory stock options, often called NSOs or non-qualified options. These are incredibly common, but their tax treatment can be a bit, well, counterintuitive sometimes. When these options are granted, the tax hit really hinges on whether they possess what the IRS calls a readily determinable value right at that initial grant date. Now, in the vast majority of cases, especially for private companies, they don't have this readily determinable value, and that critically means the taxable event usually shifts. It moves from the grant date to the exercise date.
Okay, so that sounds like a very specific, maybe legalistic definition. What does readily determinable value actually mean in a practical sense? Like, when can I look at my option grant and say, yep, that has a readily determinable value?
That's a fantastic question because, yeah, it's not as simple as it sounds. An option has a readily determinable value if it's actually traded on an established market like a stock exchange. That's the clearest, easiest indicator. If your option's publicly traded, you can see its value, bam, it has readily determinable value.
Well, simple enough.
But if it's not publicly traded, then it's a much, much higher bar to clear. For a non-publicly traded option to have this readily determinable value, all of 4 very specific conditions have to be met. Think of it like the IRS asking, is this option basically as good as cash right now?
Okay, what are those 4 conditions?
It has to be transferable, meaning you could sell it or give it away. It must be immediately exercisable in full when it's granted, so no waiting period attached. There can't be any significant conditions or restrictions affecting its fair market value. So its worth isn't tied up in, say, future company performance targets. And finally, its fair value must be, well, readily determinable, almost like you could get an appraisal for it easily.
Wow.
So for most options you see in non-publicly traded companies, meeting all 4 of those, it's extremely rare.
Understood. So, okay, let's say an SO does manage to clear that high bar. It has this readily determinable value. How is it taxed then? What does that mean for my wallet right away?
Right. In that specific, much rarer scenario, the employee recognizes ordinary compensation income right there on the grant date itself. The amount of income is equal to that readily determinable value of the option. Now, if you paid anything for the option, maybe a nominal amount, that cost would reduce the taxable income.
Oh.
The really significant thing here is that there's no further taxation when you actually exercise the option later on. That tax event is done. Your basis in the stock you eventually acquire then becomes the exercise price you pay, plus whatever amount you already recognize as income back at the grant date.
Got it. So your cost basis is higher.
Exactly. And any future sale results in a capital gain or loss, short-term or long-term, depending on how long you hold it after exercise. And your holding period for that stock, for capital gains purposes, actually begins on the exercise date, not the grant date. Oh, and if for some reason these options just lapse, you never exercise them, you can claim a capital loss based on the value you previously recognized as income at grant.
Okay, that makes sense. Let's maybe use an example to make this clearer for our listener. Could you walk us through Bob's situation? How did he navigate this scenario?
Certainly. Let's look at Bob. In year 10, Bob was granted a non-statutory stock option, an NSO, to purchase 200 shares of his employer's stock for $12 per share. Now, the key detail here, the unusual part, is that this specific option was actually selling for $4 per share on an established exchange at the time. This means it did have a readily determinable value.
Ah, okay, so he falls into that rarer category.
He does. Because of this, Bob had to report $800 in ordinary compensation income. That's the $4 per share times 200 shares right on the grant date, back in year 10. That's a tax bill he had to account for immediately, even before he actually owned the underlying stock.
Right, tax without cash flow, potentially.
Potentially, yeah. Then, there was no tax consequence when he exercised in year 11, because that tax event had already happened at grant. Later in year 12, he sold the shares for $20 per share. Now, his adjusted basis in the stock was $3,200. How did we get that? It's the $2,400 exercise price he paid, $12 times 200 shares, plus the $800 in income he already recognized at grant.
Okay, following you.
So his selling price was $4,000, $20 times 200 shares, subtract his $3,200 basis, and that results in an $800 long-term capital gain. Why long-term? Because his holding period began when he exercised in year 11, and he sold more than a year later in year 12. This example perfectly shows why that readily determinable value distinction is so crucial for the timing of income recognition. It completely changes when you pay the tax.
That's a great illustration. Yeah, it makes that early tax hit very clear. So flipping it then, if there's no readily determinable value, which you said is far more common, especially for private or non-publicly traded companies, then the taxation event shifts. What does that mean for the employee then?
Exactly. If there's no readily determinable value at grant, which is the norm, the main taxable event occurs on the exercise date. On that date, the employee recognizes ordinary compensation income, and the amount is equal to what's called the bargain element.
Bargain element. Okay, what's that?
Think of the bargain element as the immediate untaxed profit you got the moment you exercised. It's simply the difference between the fair market value of the stock on the day you exercise and the lower option price you paid for it. It's the value you received as compensation, essentially, even if it wasn't cash in your hand just yet.
Got it. The spread.
Precisely, the spread. Your basis in the stock then becomes its fair market value at exercise. So the price you paid plus that bargain element you just got taxed on. And importantly, your holding period for capital gains purposes also begins on that exercise date. Any subsequent sale leads to a capital gain or loss based on that new higher basis. And similar to the other scenario, if these options lapse unused, the employee could deduct a capital loss equal to any price they might have actually paid for the options, if anything.
Okay, so that covers non-statutory options, NSOs. Now let's shift gears and talk about statutory stock options. These include things like incentive stock options, or ISOs, and employee stock purchase plans, often called ESPPs. We often hear these receive favorable tax treatment. So what makes them favorable? What's the big difference here compared to those NSOs we just discussed?
Yeah, the favorable treatment for ISOs and ESPPs, it primarily comes from the potential to first defer the recognition of ordinary income, sometimes completely avoiding it on the option itself, and often for the entire gain from exercise to sale to be taxed at the lower long-term capital gains rates rather than higher ordinary income rates.
Right.
But, and this is a big but, there are very strict rules set by the IRS to qualify for this preferential treatment.
Oh, there's always a catch.
Always. Missing even one requirement can actually revert them back to being taxed, just like the NSOs we just talked about.
Yeah.
So attention to detail here is paramount.
Okay, lay out the strict requirements for incentive stock options, the ISOs for us. What does a listener need to know to make absolutely sure they qualify for that favorable treatment?
All right. For an option to qualify as an ISO, it really has to jump through several hoops. First, it must be granted under a written plan that's been approved by the company's shareholders. This plan has to specify the total shares available and who's eligible. The employee receiving the option cannot own more than 10% of the company's voting power at the grant date. That's a key ownership limit.
Yeah.
They also generally have to remain an employee of the granting company, or its parent or subsidiary, continuously from the grant date until 3 months before exercising the option. There's an employment requirement.
Right. Can't quit and then exercise months later, usually?
Generally, no. The options themselves must be exercisable within 10 years from the grant date. And crucially, the exercise price cannot be less than the stock's fair market value, FMV, on the grant date. No built-in discount at grant like you might see elsewhere.
Got it. No discount up front.
And here's a really significant one for getting that tax benefit. Once you exercise the option and get the stock, you must hold that stock for at least 2 years after the original grant date and at least 1 year after the actual exercise date. This is the critical holding period requirement. 2 years from grant, 1 year from exercise. Both must be met.
Okay, that's a double timeline to track.
It is. Also, there's an annual exercise limit. An employee can only exercise up to $100,000 worth of ISOs in any single calendar year. That value is based on the stock's FMV back at the grant date. Any amount exercised over that $100,000 threshold in a given year. It gets treated as a non-statutory option and is taxed according to those NSO rules we discussed earlier.
Wow, that's a lot of rules. Okay, so if someone manages to meet all those strict requirements, how are ISOs actually taxed? Where does that favorable treatment truly come into play?
So if all those conditions are met, generally, there is no taxation of the option as compensation, not at grant and not at exercise, at least for regular income tax purposes. That right there is a huge benefit compared to NSOs, where you often have ordinary income tax at exercise.
Right, deferral is key.
Exactly. Your basis in the stock you acquire is simply the exercise price you paid. The real favorable treatment, the payoff, arrives when you sell the stock. If you successfully meet those holding periods, the 2-year and 1-year rules, any gain or loss on the sale is treated entirely as a capital gain or loss. And usually, long-term capital gains are taxed at lower preferential rates compared to ordinary income. This can mean significant tax savings, especially for high earners.
Okay, but what if someone messes up the holding period, sells too soon?
Ah, yes, the disqualifying disposition. If you sell the stock before meeting both the 2-year and 1-year holding periods, you lose some of that favorable treatment. In that case, a portion of your gain, specifically the bargain element we talked about earlier, the distance between the FMV at exercise and your option price, becomes ordinary income in the year you sell. Any gain beyond that bargain element is then treated as capital gain, either short-term or long-term, depending on how long you actually held the stock from exercise to sale.
Okay, that makes sense. But you hinted earlier that ISOs have a sort of hidden gotcha connected to something called the alternative minimum tax, or AMT. Can you unpack that for us? Because that sounds like a serious pitfall that could really surprise a lot of people.
Absolutely. This is where ISOs can become quite tricky, and it's a very common area for unexpected and sometimes large tax bills. While it's true there's no regular income tax when you exercise an ISO, that bargain element, the spread between the fair market value of the stock on the exercise date and the lower price you paid, is considered an alternative minimum tax, or AMT, preference item.
Okay, a preference item. What does that mean in plain English?
Think of a preference item as a specific financial benefit that the regular tax code might let you exclude or deduct. But the IRS says, hold on, for our special AMT calculation, we're going to treat this differently. We're essentially adding it back to your income calculation, even if the regular tax code lets you slide. So for AMT purposes, this bargain element from exercising an ISO is added back when calculating your potential AMT liability.
So you could owe tax even if you haven't sold the stock.
Precisely. You might suddenly owe a significant tax bill due to the AMT without having actually sold the stock to get the cash to pay for it. The key insight here, the real heads up for listeners, is that you need a clear liquidity plan before you exercise large amounts of ISOs. Otherwise, you could find yourself in a very difficult cash position. You could owe tax but have no cash readily available unless you sell the stock, potentially forcing a sale earlier than you wanted, or maybe even during a market downturn.
That's a critical point, a real planning necessity. Let's use Mary's situation again to illustrate this AMT gotcha in action.
Okay, Mary. She received an ISO back in year 10 to purchase 200 shares for $120 per share, which happened to be the fair market value on that grant date. She exercised these options in year 11 when the stock had appreciated to $150 per share. Then in year 12, importantly, after meeting the holding periods, She sold all the shares for $200 per share.
So regular tax treatment first.
Right. Because it was an ISO and she met all the hoarding periods, Mary recognized no ordinary income at the grant date in year 10. No tax then. Her adjusted basis in the stock was simply the $24,000 exercise price she paid, 120 times 200 shares. When she sold the stock in year 12 for $40,000, 200 times 200 shares, she had a $16,000 long-term capital gain. $40,000 selling price minus the $24,000 basis. She qualified for those lower long-term capital gain rates, which is great.
Okay, now the AMT part, where does that come in?
Here's the AMT hit. Back in year 11, when she exercised the options, the stock's FMV was $150, but her purchase price was only $120. That $30 difference per share, the bargain element, multiplied by her 200 shares, resulted in a $6,000 AMT preference item. 30 by 200, it equals $6,000. This $6,000 is added back when calculating her alternative minimum taxable income for year 11. It's like phantom income, just for AMT purposes. Depending on her other income and deductions, the $6,000 preference item could potentially trigger an AMT liability in year 11, forcing her to come up with cash for the tax, even though she hadn't sold the stock yet. It really underscores the need for careful, forward-looking planning with ISOs.
That makes the AMT concern very, very clear. What about the other type of statutory option, employee stock purchase plans or ESPPs? How do they differ from ISOs, and what are the specific rules and tax treatments for them?
ESPPs offer another form of statutory option, often designed for a broader employee base than ISOs might be. They also have strict requirements. Like ISOs, they need to be shareholder approved. They generally cannot grant options to employees who own 5% or more of the company. And generally, they must be available to all full-time employees, although there can be some minor exceptions based on things like length of service.
Okay, sounds broader. What about the price?
This is a key feature. The option exercise price for an ESPP cannot be less than the lesser of 85% of the stock's FMV on the grant date, or 85% of the FMV on the exercise date. This structure often builds in a potential discount right from the start, which is very attractive.
Yeah, that 15% discount potential is nice.
Definitely. Other rules. Options cannot be exercised more than 27 months after the grant date. No employee can acquire the right to purchase more than $25,000 worth of stock per year, and that value is based on the FMV back at the grant date. And just like ISOs, there's that crucial 2-year after grant and 1 year after exercise holding period requirement to get the full capital gains treatment. And similarly, the employee must remain employed until 3 months before exercise.
And the taxation of ESPPs, are there any unique twists there compared to the ISOs, especially with that potential discount?
Similar to ISOs, there's generally no compensation taxation initially when the option is granted or exercised. Your basis in the stock you buy is simply your exercise price. If you meet that 2-year or 1-year holding period, any gain or loss is typically treated as capital gain or loss. However, and here's the unique ESPP twist, if the exercise price was actually less than the FMV on the grant date, which is often the case due to that 85% rule, then when you sell the stock, a portion of your gain is recognized as ordinary income, even if you met the holding periods.
Ah, okay, so some ordinary income, even with holding periods met. How much?
The amount of ordinary income recognized is the lesser of two things. Either your actual gain on the sale, the FMV when sold minus your exercise price, or the discount you received at the grant date, calculated as the difference between the FMV at grant and your exercise price, though often framed as the exercise price itself if it was 85% of grant FMV. Any gain beyond that specific ordinary income amount is then treated as capital gain, long-term if holding period is met. This unique rule for ESPPs essentially recognizes that built-in discount you might have received up front as a form of compensation, eventually taxed as ordinary income.
Okay, so here's where it gets really interesting for you, the listener, for both ISOs and ESPPs. That 2-year after grant and 1 year after exercise holding period is basically your golden ticket. It's what gets you that potentially lower long-term capital gain treatment on most, if not all, of your profit. Miss it, sell too early, and you're looking at potentially a chunk of that gain being taxed as ordinary income, maybe at much higher rates. So what does this all mean? Bottom line, keep meticulous track of those dates. Grant date, exercise date, sale date. Set reminders, use spreadsheets, whatever it takes, because those dates literally dictate your tax bill.
Absolutely. Couldn't agree more. Now, let's pivot slightly to restricted stock and restricted stock units, often called RSUs. These are handled a bit differently from options because they typically involve receiving actual shares, or at least a promise of shares, rather than just an option to buy them later.
Right. So for restricted stock, the employee gets actual shares up front, but they come with strings attached, right? They can't sell or transfer them until they vest. How does that vesting restriction impact the timing of taxation?
With restricted stock, The employee typically recognizes ordinary compensation income for the full fair market value of the stock, but not a grant. The income is recognized on the vesting date. That's the key date here, when the restrictions finally lapse and the shares become truly yours, freely transferable. Your basis in the stock then becomes that fair market value on the vesting date, and your holding period for capital gains purposes also begins on that vesting date.
So if the stock price goes up significantly between the grant date and the vesting date, that entire increase gets taxed as ordinary income at vesting.
That's exactly right. That appreciation from grant to vesting is treated as ordinary compensation income on top of the initial value at vesting. That can lead to a pretty big tax hit all at once.
But there's a key tax planning move here, isn't there? Something called the Section 83B election. This sounds like a way someone might potentially get ahead of that tax curve, maybe?
Yes. The 83B election is a significant and often crucial planning opportunity, particularly if you're at a company where you expect the stock value to grow substantially. An employee may elect it's optional to recognize ordinary compensation income for the fair market value of the stock on the grant date instead of waiting until the vesting date.
Okay, why would someone choose to pay tax earlier? What's the potential benefit?
Well, the primary benefit is twofold, really. First, if you strongly believe the stock is going to appreciate significantly between grant and vesting, you could recognize income at a potentially much lower fair market value at the grant date compared to what it might be worth later at vesting. This means less ordinary income overall. Second, making the 83B election starts your holding period for long-term capital gains right from the grant date, not the vesting date. This could potentially convert more of your future appreciation into preferentially taxed long-term capital gain.
But it sounds like a bit of a gamble, too.
It absolutely is a gamble. You're paying tax upfront on something that could theoretically lose value before it vests, or you might even forfeit the shares if you leave the company before vesting. Also, this election must be made very quickly within 30 days of the grant date, and it's irrevocable. Once you make it, you can't change your mind. You're effectively prepaying tax on an uncertain future value.
Got it. So let's look at Agnes. She has restricted stock. How does her situation play out if we assume she doesn't make that 83B election? What does she need to consider?
Okay, Agnes. In year 10, she was granted 200 shares of restricted stock. At that time, the FMV was $100 per share. These shares vested, meaning the restrictions lapsed, in year 11 when the FMV had risen to $110 per share. She then held them for a while and sold them in year 12 for $125 per share. So in year 10, the grant year, she had $0 taxable income because, as we're assuming, she didn't make the 83B election. The shares were restricted, so no immediate tax hit. But then, in year 11, on the vesting date, she recognized a substantial $22,000 in ordinary compensation income. That's the $110 vesting date FMV times 200 shares. That $22,000 also became her cost basis for the stock.
Right. Taxed on the value when she truly received it without restrictions.
Exactly.
Yeah.
When she sold the stock in year 12 for $25,000, 125 minus 200 shares, she had a $3,000 long-term capital gain. That's the $25,000 selling price minus her $22,000 basis. It's long-term because her holding period for capital gains began on the vesting date in year 11, and she sold more than 1 year later in year 12. This example clearly shows how that appreciation from $100 a grant to $110 at vesting gets captured as ordinary income if you don't make the 83B election.
That makes sense. And restricted stock units, RSUs, are they basically the same as restricted stock, or is there a key difference in how they're taxed maybe with that 83B election?
They are very similar in their taxation timing, but there's a crucial structural difference up front. RSUs are not actual shares given to you at grant. Instead, they're essentially a promise from your employer to give you a specified number of unrestricted shares on a future vesting date.
Ah, so it's a promise, not the shares themselves initially.
Right. The taxation works just like restricted stock without an 83B election.
Yeah.
You recognize ordinary compensation income for the fair market value of the stock received on the vesting date. But crucially, because you don't technically own any shares until that vesting date, no 83D election is allowed for RSUs. That option is off the table. This eliminates that potential early tax planning opportunity you have with restricted stock.
Good distinction. Lastly, what about stock appreciation rights, SARs? How do they fit into this whole equity compensation puzzle? Are they common?
SARs are another form, maybe slightly less common than options or RSUs in some sectors, but still out there. With SARs, employees don't receive actual stock at all, nor do they typically exercise an option to buy stock. Instead, when they exercise a SAR, they receive a cash payment. and that payment is equal to the increase or appreciation in the stock's value from the grant date up to the exercise date.
So it's purely a cash payout based on stock performance.
Exactly. And that cash payment is recognized entirely as ordinary compensation income when exercised. It's pretty straightforward, in some ways simpler than stock options, because there's no underlying stock ownership to track for basis or holding periods later on. The entire gain you realize from the SAR is just straight ordinary income in the year you trigger it.
Okay, let's unpack this next big topic. Beyond your actual compensation structure, how you time your income and expenses can be one of the most powerful and, honestly, often overlooked tax saving strategies out there. It's kind of like playing financial chess, right? You're making moves to maximize your after-tax wealth. So what this means for you, our listener, is that a seemingly small decision, like maybe holding off on invoicing a client for just a few days around year end, or deciding to prepay that annual professional membership in December instead of January, it isn't just about good accounting. It can actually put literal thousands more dollars in your pocket over time. It's truly a potential game changer for anyone actively planning their finances.
That's an excellent analogy, and you've really hit on the core principle there. The general rule of thumb for timing, and this assumes your marginal tax rates remain constant from year to year, which is a big assumption we'll revisit, is elegantly simple. Generally, you want to defer taxable income into a future year and accelerate tax deductions into the current year.
Okay, defer income, accelerate deductions. Why does that work?
It relies heavily on the fundamental concept of the time value of money. Simply put, a dollar saved in taxes today is generally worth more than a dollar saved tomorrow. Why? Because you can take that saved dollar today, invest it, and earn a return on it immediately. It's all about optimizing the timing of your cash flows relative to when you have to pay the tax man.
Can you walk us through a clear example of deferring income, maybe when tax rates are stable? How does that actually put more money in someone's pocket in real terms?
Certainly. Let's consider Jill again. She's a freelance graphic designer, operates on a cash basis, and let's assume she has a steady 32% marginal tax rate this year and next. She just finished a big project and has the choice: invoice her client for $100,000 on December 31st of the current year, or wait just one day and invoice on January 1st of the next year.
Okay, classic year-end timing decision.
It's exactly. If she recognizes the $100,000 income this year, she'll pay $32,000 in tax on that income relatively soon, leaving her with $68,000 after tax from that project. Now, if she defers it by invoicing on January 1st, she still owes $32,000 in tax eventually, but she gets to pay it a whole year later. When we look at the present value of that tax payment, basically, what that future $32,000 tax payment is worth in today's dollars, assuming she can earn, say, a 10% after-tax rate of return on her money, that $32,000 tax paid next year is effectively worth only about $29,088 today.
Because money today is worth more than money tomorrow.
Precisely. So her after-tax income from deferring, when considered in today's dollars, is effectively $70,912. That's the $100,000 income minus the $29,088 present value of the tax. Compare that to the $68,000 she'd have if she took the income this year. That's an additional $2,912 in her pocket in today's dollars, just from delaying the income recognition by one day across the year end. So deferring income when rates are constant means you're pushing off that tax payment, allowing you to use that money for longer, potentially earning a return on it.
That perfectly illustrates the time value of money principle at work. Simple but powerful. And how about the flip side? Accelerating a deduction. How does that strategy improve her after-tax position?
Okay, using Jill again. Let's imagine she's planning to buy $20,000 worth of new design equipment for her business. She can either make the purchase this year, say in December, or wait until next year, maybe January. We're still assuming her 32% marginal tax rate is constant. If she buys the equipment this year, she gets a $20,000 deduction right away. At her 32% rate, that deduction immediately leads to $6,400 in tax savings. $20,000 by 0.32. So her effective after-tax cost for the equipment is only $13,600. $20,000 cost minus the $6,400 tax savings. Now, if she waits until next year to buy it, she still gets the same $20,000 deduction and the same $6,400 tax savings eventually, but that saving comes a year later. The present value of that $6,400 savings received next year, again using our 10% discount rate, is only worth $5,818 today. So her effective after-tax cost, in present value terms if she waits, is $14,182 to earn. $20,000 cost minus the $5,818 present value of the savings. By accelerating the deduction into this year, she makes the equipment about $582 cheaper in today's dollars, $14,182, $13,600. Again, it shows the power of acting sooner on deductions. You get the tax benefit earlier, which is always more valuable from a time value of money perspective.
That makes perfect sense. But, the real world is rarely that simple with constant tax rates. What happens when the game changes? What if your tax rate isn't constant? Maybe Congress changes the law, or you anticipate a big life event like retirement or starting a business that dramatically shifts your income bracket. This seems like a much more dynamic and, frankly, realistic tax environment.
You've absolutely hit on the key complication that makes tax planning more of an art, not just a simple science. Changing tax rates, whether they're going up or down due to new tax laws, or because a personal situation changes, like a planned retirement, starting a new high-income venture, or even just getting married or divorced, they fundamentally alter that basic deferral acceleration strategy.
How so? Give us an example.
Well, for instance, if you anticipate being in a much lower tax bracket in retirement, which is common, it might actually make sense to accelerate income into a current, higher tax year if the future rate drop is significant enough and outweighs the time value benefit of deferral. You might want to realize gains now rather than later at a slightly lower rate, but further in the future. Conversely, if you know you're going to have a huge surge in income next year, maybe selling a business, you might want to aggressively pull more deductions into this year to offset your currently lower income, maximizing the value of those deductions before your rate jumps.
So it's not just rates, other factors come into play too.
Definitely. You also need to consider the type of income. Is it ordinary income tax at high rates or long-term capital gains tax preferentially? The type of entity you operate through, are you a sole proprietor or is it an S Corp or C Corp? And your filing status, as we mentioned. All these factors interact with changing rates and influence the optimal timing strategy.
Okay, so let's revisit Jill's $100,000 sale example. What if her tax rate is actually increasing next year? Maybe she expects a promotion or new legislation passes. Does deferring income still make sense then, or could it actually backfire on her?
Great question. Let's change the facts slightly for Jill's $100,000 sale. Her marginal tax rate is 32% this year, but she anticipates it jumping to 35% next year. If she recognizes the income this year at 32%, her after-tax income is still $68,000. If she defers it to next year, she now faces that higher 35% rate, meaning she'll pay $35,000 in tax next year. The present value of that higher $35,000 tax payment, discounted at 10%, is about $31,815. So her effective after-tax income from deferring, in today's dollars, is now $68,185 THAMS, $100,000 income minus the $31,815 present value of tax.
So deferring is still slightly better.
Yes. In this specific case, deferring is still slightly more attractive. She comes out ahead by about $185 in today's dollars. But notice how much the benefit has shrunk compared to the $2,912 benefit when rates were constant. This demonstrates that blindly deferring isn't always the optimal move when rates are rising. You might save a bit on the time value of money, but you could end up paying significantly more tax overall if the rate jumps high enough to outweigh that time value benefit.
Right, the math gets much closer. And what's the implication for accelerating deductions if her rate is increasing? Does that strategy still hold up as strongly?
Let's look at her $20,000 equipment purchase again, with the rate going from 32% this year to 35% next year. Accelerating the deduction into this year at 32% still gives her that immediate $6,400 tax saving, resulting in an after-tax cost of $13,600 today. If she waits until next year, her deduction is theoretically worth more because her rate is higher. It would yield $7,000 in tax savings, $20,000 by 35%. However, when we discount that future $7,000 saving back to today's value at 10%, its present value is only $6,363. So her effective after-tax cost if she waits would be $13,637, $20,000 cost minus $6,363 present value saving.
So accelerating is still better, but barely?
Exactly. Accelerating is still slightly more attractive, but only by about $37 in this scenario. What this really tells us is that when tax rates are expected to increase, the financial benefit of accelerating deductions or deferring income shrinks considerably. It might still be the right move, but the payoff is much smaller. This is where forecasting your income, your likely deductions, and your probable future tax brackets becomes absolutely essential. You can't just rely on the simple rule of thumb.
Yeah, this definitely raises an important question. It's clearly not just about simple deferral or acceleration. You absolutely must forecast your specific personal situation and consider potential tax law changes on the horizon. It's a much more dynamic calculation that requires careful, forward-looking consideration each year.
Precisely. Your unique facts and circumstances are paramount. What works brilliantly in one year or for one person might be the completely wrong move for another, especially with shifting rates, significant life events like retirement or major business deals, or even just broad changes in the overall economic environment affecting investments. This is exactly why annual tax planning, ideally with a forward-looking perspective, is so incredibly crucial.
Okay, shifting gears a bit. You might think, a friendly loan to your brother-in-law or maybe a relocation loan from your employer is pretty simple, right? But did you know even those seemingly straightforward arrangements can have unexpected tax implications? We're talking about navigating these below market rate loans, where the IRS can actually step in and, well, impute interest income that was never actually paid or received.
That's absolutely right. The IRS has specific rules, Section 7872 of the Code, for those interested, designed pretty much to prevent tax avoidance through loans that carry little or no interest. They're trying to stop scenarios where, for example, a high-income parent lends a large sum to their child at 0% interest. Without these rules, that's effectively gifting income potential. The interest the child avoids paying and the parent avoids receiving without any tax consequence.
So the IRS basically says, nice try, but we're going to pretend some interest was paid.
Essentially, yes. If a taxpayer makes a below-market rate loan, meaning the interest rate charged is lower than the current applicable federal rate, or AFR, which the IRS publishes monthly, the lender might have to report what's called foregone interest as interest income on their tax return. Think of foregone interest as the interest the IRS imagines you should have earned or paid because the loan was below their benchmark rate, the AFR, compared to any interest that was actually stated or paid on the loan. It's phantom income for the lender and potentially phantom interest expense for the borrower, depending on the loan type.
That sounds like a potential surprise for a lot of people making informal loans. What types of loans typically fall under these imputed interest rules?
The rules apply to several specific categories, and the exact treatment can vary slightly, depending on the relationship between the lender and borrower. Gift loans. These are probably the most common ones. People encounter loans between individuals like friends or family members, where the foregone interest is generally treated as a gift from the lender to the borrower, and then imputed interest income back to the lender. Compensation-related loans. Think of a loan from an employer to an employee, maybe interest-free to help with a down payment on a house near the new job. Here, the foregone interest is typically treated as taxable compensation paid to the employee, and then imputed interest income back to the employer, and potentially deductible interest expense for the employee, if used for a qualifying purpose like a mortgage. Corporation shareholder loans. Loans between a corporation and its shareholders, where the foregone interest might be treated as a dividend or a contribution to capital, depending on who is lending to whom. Tax avoidance loans. This is a catch-all for any below-market loan where one of the principal purposes is avoiding federal tax, regardless of the relationship. And there are also specific rules for certain loans to qualify continuing care facilities, often involving elderly individuals making loans in exchange for care.
Okay, that covers a lot of ground. Can you give us a concrete example of how this foregone interest actually plays out in a real-life scenario? Let's make it tangible.
Sure. Let's consider Pat and Robert again. Pat needs a $20,000 loan to cover some unexpected home repairs. Robert, a good friend, agrees to lend it to him for a year at a friendly 1% annual interest rate. However, let's say the current applicable federal rate, AFR, for short-term loans, published by the IRS, is 3%. Under the imputed interest rules, Robert, the lender, must calculate the minimum interest required by the AFR, which would be $600, $20,000 by 3%. Since Pat is only actually paying Robert $200, $20,000 by 1%, the foregone interest is the difference. $400 required, $200 paid. Robert must report this $400 as imputed interest income on his tax return, even though he never actually received that $400 in cash from Pat. It's a crucial detail many people miss in casual loans, and it can lead to unexpected tax liabilities for the lender.
Yeah, that is definitely a true gotcha moment waiting to happen for many generous friends or family members. Are there any important exceptions to these rules, ways to avoid this imputed interest trap, especially for smaller loans?
Yes, thankfully the IRS isn't trying to police every tiny loan. There are some vital exceptions. First, there's a key de minimis exception. Generally, these imputed interest rules do not apply to loans between the lender and borrower if the total outstanding amount of loans between them does not exceed $10,000.
Okay, $10,000 or less, you're usually safe.
Usually. There's a small condition for gift loans under $10,000. This exception doesn't apply if the loan is directly used to purchase or carry income-producing assets. So if you lend your child $5,000 interest-free just for living expenses or a car, you're probably fine. But if they immediately use it to buy dividend stocks, the rules might still apply. For compensation-related or corporate shareholder loans under $10,000, the de minimis exception applies as long as tax avoidance wasn't a principal purpose of the loan.
Got it. Are there broader exceptions beyond just the small loan amount, maybe for specific types of loans that are common?
Yes, there are some general exceptions for loans where the interest arrangement is deemed not to have a significant effect on the federal tax liability of either the lender or the borrower. These often include things like government-subsidized loans, think federal student loans, loans that are consistent with a lender's normal business practices, like maybe a store offering zero-interest financing on furniture, as long as it's offered widely. Certain loans to help employees with work relocation expenses, some loans involving foreign persons, and importantly, gift loans made to qualified Section 501c3 charitable organizations, provided the total outstanding loans to that charity don't exceed $250,000.
Okay, that's helpful. Now, what about larger gift loans, say between family members, maybe $50,000 or $80,000? Is there a special rule that helps avoid or limit the imputed interest there beyond the $10,000 de minimis?
Yes. There is another very important exception specifically for gift loans between individuals totaling $100,000 or less. For these loans, the amount of foregone interest that the lender has to include in their income is limited. It's capped at the borrower's net investment income for the year. And here's the really useful part. If the borrower's net investment income for the year is $1,000 or less, the foregone interest included in the lender's income is treated as zero.
So if the borrower isn't really earning investment income, the lender might not have any imputed interest even on a larger loan.
Exactly. So if you lend, say, $50,000 interest-free to your adult child to help them with a down payment on their primary residence, which typically doesn't generate net investment income for them, and their actual net investment income from other sources is under $1,000, you likely won't have any imputed interest income to report, even though the loan is over $10,000. This is a very vital planning tip for facilitating intra-family loans without triggering unexpected tax consequences for the lender.
That's incredibly useful information. Okay, now let's talk about tools that are explicitly designed for tax savings right out of your paycheck. Things like flexible spending accounts or FSAs. These seem like a straightforward way to save on everyday medical or childcare costs.
They really are. Flexible spending accounts or arrangements allow employees to get reimbursed on a pre-tax basis for qualified medical expenses and qualified dependent care expenses. They're typically funded through voluntary salary reduction agreements with your employer. This means the money comes out of your paycheck before any income or employment taxes, like Social Security and Medicare, are calculated. For 2023, the maximum contribution you could make to a health FSA was around $3,050. The limits for dependent care FSAs are different, often around $5,000 per household.
And the benefits are pretty clear, right? Lower taxable income.
Absolutely. The key benefits are significant and twofold. First, the contributions themselves are excluded from your gross income, so you're not paying federal income tax or FICA taxes on that portion of your salary. That's immediate savings. Second, when you get reimbursed from the FSA for your qualified expenses like doctor visit copays, prescriptions, daycare costs, those reimbursements are completely tax-free. It's essentially like getting a discount on those expenses equal to your marginal tax rate.
Okay, the big, well-known gotcha with FSAs is that infamous use it or lose it rule. That sounds scary. How can people avoid forfeiting their hard-earned pre-tax money at the end of the plan year? What's the strategic play here?
That's the primary consideration that makes careful FSA planning crucial throughout the year, especially towards the end. Generally, any funds left in your FSA account at the end of the plan year are forfeited back to the employer. You lose them. However, employers typically have the option to offer one of two features to mitigate this risk for employees. They're not required to, but many do. Option one is a grace period. They might provide a 2.5-month grace period after the end of the plan year, so until March 15th for a calendar year plan, during which you can still incur eligible expenses and use up the prior year's remaining funds. Option two is a carryover. They might allow you to carry over a limited amount of unused funds for 2023. The maximum carryover was $610 into the following plan year. This carryover amount doesn't count against your contribution limit for the new year.
So you really need to know your specific employer's plan rules.
Absolutely crucial. Does your plan offer a grace period, a carryover, or neither? Knowing that dictates your strategy. If you have a use it or lose it plan with no relief, you need to estimate expenses very carefully. If you have a grace period or carryover, it gives you more flexibility. Strategic year-end spending might involve stocking up on eligible over-the-counter medications, getting that extra pair of glasses, scheduling an elective dental procedure, or prepaying for orthodontist visits if allowed. The key is, don't leave those pre-tax dollars on the table.
Good advice. Now, if FSAs are good, health savings accounts, HSAs, are often described with glowing terms like triple tax advantage accounts. Here's where it gets really interesting, because these accounts aren't just for current medical expenses, they can be incredibly powerful long-term wealth-building tools.
Health savings accounts, HSAs, are truly powerful and unique in the tax code. An HSA is essentially a tax-deferred savings account, structurally quite similar to an IRA, but specifically designated for paying qualified medical expenses. The triple tax advantage comes from three distinct tax benefits, which is rare. First, your contributions are tax-deductible if you contribute directly, or made pre-tax if done through payroll deductions. Either way, it immediately lowers your current taxable income. Second, any earnings or growth on the money inside the HSA, whether from interest or investments, as many HSAs allow you to invest the funds, accumulates completely tax-free. And third, when you take withdrawals to pay for qualified medical expenses, those withdrawals are also completely tax-free. And the big difference from an FSA is the rollover. That's the game changer. Unlike an FSA, HSA funds that you don't spend in a given year don't get forfeited. They simply remain in your account, continue to grow tax-free, and roll over year after year indefinitely. This makes them a true long-term savings vehicle that you own and control, even if you change jobs or health plans later.
Okay, so what are the contribution limits for HSAs? How much can people sock away in these accounts? And is there a catch, like a specific requirement to even be eligible to contribute?
For 2023, the maximum pre-tax contributions were approximately $3,850 for individuals with self-only health coverage and $7,750 for those with family coverage. Plus, if you're age 55 or older by the end of the year, you can contribute an additional $1,000 as a catch-up contribution on top of those limits. Now, the crucial prerequisite, the catch you mentioned, which can be a barrier for some, is that you can only contribute to an HSA if you're currently insured under a high-deductible health plan, or HDHP.
Ah, the HDHP requirement. What qualifies as an HDHP?
For 2023, to qualify as an HDHP, the health plan had to have a minimum annual deductible of $1,500 for self-only coverage, or $3,000 for family coverage. There were also maximum annual out-of-pocket limits around $7,500 for self-only and $15,000 for family coverage. These limits include things like your deductible and co-payments, but not your plan premiums. So the trade-off is, you choose an HDHP, which typically has lower monthly premiums, but requires you to pay more out-of-pocket initially via the higher deductible, and in exchange, you gain access to this incredibly powerful, tax-advantaged HSA savings vehicle.
That makes sense. And the withdrawal rules for HSAs. You mentioned they're a strategic goldmine, especially thinking long-term towards retirement. This sounds like where the real long-term planning power shines.
Indeed it does. The withdrawal rules are what elevate the HSA beyond just a medical spending account. Of course, withdrawals used to pay for qualified medical expenses are always tax-free, regardless of your age. That's their primary purpose. Now, if you take money out for non-qualified expenses, basically, anything other than medical costs before you reach age 65, those withdrawals are included in your gross income, and they're hit with an additional 20% penalty tax. So you definitely want to avoid doing that if possible.
Okay, penalty before 65. What happens after 65?
Here's the magic transition. Once you reach age 65, if you take withdrawals for non-qualified expenses, they are still included in your gross income, just like a withdrawal from a traditional IRA or 401k, but that hefty 20% penalty no longer applies. This is why HSAs are often viewed as a fantastic supplemental retirement account. After 65, you can use the funds for anything travel, hobbies, living expenses, and they're simply taxed as ordinary income. But here's an even more powerful benefit, particularly for retirees. Withdrawals used to pay for certain healthcare costs in retirement continue to be completely tax-free, even after age 65. This includes premiums for Medicare Parts A, B, and D, and also premiums for qualified long-term care insurance. This is an enormous advantage that many people overlook when planning for retirement healthcare costs.
Wow, paying Medicare premiums tax-free from an HSA sounds amazing. Let's illustrate how Pat and Roger Martin, that couple we mentioned, use their HSAs to their advantage in retirement. This example really seems to showcase the power of the HSA for long-term financial well-being.
Okay, Pat and Roger, they're a married couple, age 65 and 66, so they're navigating retirement expenses. They're enrolled in Medicare, and between their Part B and Part D premiums, their annual cost is $4,000. They also wisely have qualified long-term care insurance policies with annual premiums totaling $5,000. So their combined healthcare-related premiums come to $9,000 per year. They typically take the standard deduction on their tax return, so they aren't itemizing medical expenses.
So how does the HSA help them here?
Here's their smart move. They have accumulated funds in their HSAs over the years. Now, they pay these $9,000 in premiums directly using tax-free withdrawals from their HSAs. Because these specific premiums, Medicare A, B, D, and qualified LTC insurance, are considered qualified medical expenses for HSA purposes, even after age 55, these distributions come out completely tax-free. Let's say their marginal tax rate in retirement is 22%. By paying these expenses with tax-free HSA dollars instead of after-tax dollars from other accounts, they effectively gain an additional $9,000 premium cost by 0.22 tax rate per year in spendable after-tax income. This is money that would otherwise just be lost to taxes if they paid those premiums from, say, a regular checking account or even a traditional IRA withdrawal. It's a direct, tangible benefit that significantly boosts their after-tax cash flow in retirement, freeing up other retirement savings for other purposes. It highlights the HSA's value long after your working years.
That is a fantastic illustration of the long-term power. Okay, switching gears again slightly. When it comes to actually lowering your taxable income on your return each year, you've generally got two main paths. Take the simple standard deduction or go through the process of itemizing specific deductions. But which one is right for you? And more importantly, how can you optimize this choice to keep more of your hard-earned money?
Right. The standard deduction is, well, the standard approach for many. It's a fixed base amount that most taxpayers can claim without having to track every single specific deductible expense. Its main purpose is to simplify tax filing for millions of people. For the 2023 tax year, the standard deduction amounts were roughly $13,850 for single filers, $20,800 for head of household filers, a larger $27,700 for those married filing jointly or qualifying surviving spouse, and back down to $13,850 for those married filing separately. It's designed as a basic allowance that reduces your adjusted gross income down to your taxable income.
And you mentioned there's often an additional amount for older taxpayers or those who are blind, correct? How does that work and who benefits most from that?
Yes, that's a very important detail, especially relevant for our older listeners or those with visual impairments. The standard deduction amount is increased by an additional fixed amount if you are age 65 or over by the end of the tax year, or if you are legally blind. For a single taxpayer or head of household, that extra amount was $1,850 for 2023 for each condition, age 65 plus or blindness. For married taxpayers, the additional amount was slightly lower, $1,500 per qualified person per condition. So for example, if you're single, 70 years old, and also legally blind, you'd get your base standard deduction plus 2 times under $850 added on top. This can significantly increase the total standard deduction, making it a much more attractive option and a powerful, often overlooked tax break for seniors and the visually impaired.
Okay, so given these standard deduction amounts, which can be quite substantial, especially with the additional amounts, when does it actually make sense for someone to put in the extra effort, the record keeping, the tracking, to itemize their deductions instead? What are the telltale signs that itemizing might be beneficial for a listener?
The basic rule is simple. You'll choose to itemize your deductions only when your total allowable itemized deductions for the year exceed your applicable standard deduction amount. If your itemized total is less than the standard, you just take the standard deduction. You always get the better of the two. This means, yes, keeping careful records throughout the year is key if you think you might be close. Common itemized deductions that people track include medical expenses, but only the amount that exceeds 7.5% of your adjusted gross income, AGI. That's a high hurdle for many. State and local taxes paid, often called SALT. This includes income taxes or sales taxes, you choose one, plus property taxes. However, this total SALT deduction is currently limited, capped at $10,000 per household per year, $5,000 if married filing separately. That cap makes itemizing harder for people in high-tax states. Home mortgage interest on qualifying debt. Investment interest expense, but generally only up to the amount of your net investment income. Charitable contributions made to qualified organizations. There are percentage limits based on your AGI, but they are quite high for cash contributions. And casualty or theft losses, but only those attributable to a federally declared disaster. And even then, only the amount exceeding $100 per casualty and 10% of your AGI in aggregate. So this is rare.
Okay, so what are the signs? When should someone really start digging into their receipts?
Itemizing might be beneficial if you consistently make very large contributions to qualified charities each year, or if you have significant uninsured medical and dental expenses that actually clear that 7.5% AGI threshold. If you carry a substantial mortgage with high interest payments, or pay significant property taxes, even with the fault cap, it contributes. Or, unfortunately, if you experience a major uninsured loss in a federally declared disaster area. Basically, if you look at those categories and think, yeah, my expenses there seem pretty high, and you consistently find your potential deductible expenses hovering near or maybe just slightly below your standard deduction amount year after year, then you might be a perfect candidate for our next strategy.
Right. This is where we talk about a clever strategy that can really make a difference if you're always just shy of itemizing. It's called bunching your itemized deductions. Now, this might sound like an advanced accountant move, but it's actually pretty accessible once you understand it.
Bunching is indeed a smart planning move, and you're right, it's not as complicated as it sounds. It's really all about strategic timing of certain flexible expenses. The core idea is to intentionally consolidate or bunch 2 or more years' worth of certain controllable itemized deductions, things like charitable contributions or perhaps elective medical procedures, into a single tax year. By doing this, you artificially inflate your itemized deductions in that bunching year, hopefully pushing the total well above the standard deduction threshold, thereby maximizing your tax benefit in that specific year. Then in the following year, or years depending on your strategy, when your itemized deductions are naturally lower because you prepaid them in the bunching year, you simply take the standard deduction, which is likely higher in that off year. This strategy can also be particularly useful for navigating that restrictive $10,000 state and local tax, SALT limitation. By bunching other deductions, you might make itemizing worthwhile even with the SALT cap. Or you might choose to accelerate or defer property tax payments, if possible in your locality, into the bunching year to make sure you get the full $10,000 benefit in that year.
That makes sense conceptually. Let's walk through Elizabeth Roberts' situation to see exactly how this works in practice. Because this example really seems to illustrate the power of bunching, especially when combined with other life changes.
Okay, Elizabeth. She's a 64-year-old single taxpayer. Let's look at her typical annual expenses that could be itemized. She consistently pays $7,500 in state and local taxes. Hitting the SALT cap isn't her issue. She has $3,000 in deductible home mortgage interest. And she usually contributes a steady $2,500 each year to her church, a qualified charity. So her total potential itemized deductions each year add up to $13,000. $7,500 plus $3,000 plus $2,500.
Okay, $13,000. And what's her standard deduction as a single filer under 65?
Her standard deduction for 2023 as a single filer under 65 is $13,850. So you can see, if she just continued making her $2,500 charitable contribution annually, her $13,000 total itemized deduction would always fall short of her $13,850 standard deduction. She'd just take the standard deduction every year and effectively get no additional tax benefit from her mortgage interest or charitable giving beyond what the standard deduction already covers.
Right, she's leaving tax savings on the table. So how does bunching help her, especially considering she's approaching age 65?
This is where the planning comes in. The best option for Elizabeth is to bunch her charitable giving. Instead of giving $2,500 in year one and $2,500 in year two, he should make both contributions a total of $5,000 in year one. This strategic move increases her year one itemized deductions significantly. They now total $15,500. That's the $7,500 SALT plus $3,000 mortgage interest plus the $5,000 bunch charitable contribution. This $15,500 total is now $1,650 more than her year one standard deduction of $13,850. By itemizing in year one, she reduces her taxable income by that extra $1,650, saving her real tax dollars at her marginal rate.
Okay, so she gets a benefit in year one. What happens in year two when she makes no charitable contribution?
Right. In year two, her itemized deductions without the extra charity would drop back down to just $10,500, $7,500, SALT plus $3,000 mortgage interest. That's clearly lower than the standard deduction. But here's the brilliant part, where her age comes into play. In year two, Elizabeth turns 65. This means she becomes eligible for that additional standard deduction amount for age. As a single filer, that adds $1,850 to her base standard deduction. So her year two standard deduction jumps up to $15,700, $13,850 plus $1,850 age allowance. Since $15,700 is significantly more than her $10,500 itemized deductions in year two, she simply takes the higher standard deduction. By bunching, she cleverly managed to itemize and get a benefit in year one, and then still benefit from a very attractive age-boosted standard deduction in year two. This results in a real, tangible tax saving over the 2-year period that she absolutely wouldn't have achieved by just taking the standard deduction each year without thinking about timing. The fantastic illustration of how planning, especially anticipating life changes, really pays off.
That is a great example. Okay, let's move on to some special circumstances. For those listeners who have an international lifestyle or maybe are just considering working abroad for a period, this next tip could literally save you tens, maybe even hundreds of thousands of dollars over time. We're talking about the Foreign Earned Income Exclusion, or FEIE, and it's a truly huge benefit for qualifying U.S. expats.
This is indeed a massive tax break, one of the most significant available to individual U.S. taxpayers who work abroad. If you qualify, you may elect to exclude a substantial amount of income you earn while residing and working in a foreign country from your U.S. gross income. For the 2023 tax year, that exclusion amount was up to $120,000. To really grasp the impact of excluding $120,000 from your income, think about it. Even at a modest 24% marginal tax rate, that's potentially $28,800 in federal income tax savings, $120K by 24, directly in your pocket each year you qualify. If you're in the highest 37% marginal rate bracket, the savings could be as much as $44,400, $120K by 337. That's a significant portion of your earned income that remains completely untaxed by the U.S. government, directly boosting your after-tax earnings and making international assignments much more financially attractive.
That is truly significant savings. What exactly counts as foreign earned income for this exclusion? Is it just your salary or are other types of income included as well?
It specifically applies to income earned from personal services performed in a foreign country. So this definitely includes active income items like salaries and wages, bonuses, commissions, professional fees you earn from clients abroad, and even tips received for services performed overseas. It generally does not apply to passive income sources like dividends, interest, capital gains, or rental income unless running the rental property is your active trade or business abroad. Pensions and annuity payments are also typically excluded. The key is that it's compensation for your labor performed while you are physically outside the United States. Okay, active services performed abroad. And how does someone actually qualify for this significant exclusion? It sounds too good to be true, so there must be specific tests, right? Like, how long do you need to be out of the country?
Yes, it does sound good, and yes, you absolutely must meet specific residency or presence requirements to qualify. You have to satisfy one of two rigorous tests. The first is the bona fide residence test. This test is more about your intentions and your ties to the foreign country. It requires you to establish that you have been a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire taxable year, January 1st to December 31st. This means your primary home, your social and economic ties should genuinely be established abroad. It's a qualitative test based on facts and circumstances. The second test, which is often easier for many people to meet, especially for temporary assignments, is the physical presence test. This one is purely quantitative, based on days. It requires you to be physically present in a foreign country or countries for at least 330 full days during any 12 consecutive month period. The 330 days do not need to be consecutive, and the 12-month period doesn't have to align with the calendar year. So you can travel back to the U.S. for short visits, up to about 35 days in the 12-month period, and still potentially qualify.
Okay, bona fide residence or physical presence. Can you give us a quick, real-world example of someone who qualifies, maybe using the physical presence test?
Sure. Let's take Thomas Peters again. He's a single U.S. citizen who moved to Israel exactly 12 months ago today for a job as a full-time tour guide. Since moving, he's only been back home to Idaho for a 2-week visit, 14 days, to see his family over the holidays. Because he was physically present in a foreign country, Israel, for 351 days, that's 365 total days in the 12-month period minus the 14 days he spent in Idaho, he easily satisfies the 330-day physical presence test. As a result, his foreign earned income from guiding tours in Israel during that period qualifies for the exclusion up to the $120,000 limit for 2023, potentially putting tens of thousands of dollars back into his wallet compared to if he'd earned that same income working in the U.S.
That makes it very clear. Okay, next topic. If you're a parent trying to plan for your child's future, maybe considering investments in their name, or perhaps even if you're a young earner yourself still claimed as a dependent, you absolutely need to understand the kiddie tax. This is a set of rules that can really surprise families who aren't aware of it.
The kiddie tax is definitely something parents need to be aware of when structuring investments for their children. It was specifically designed, going back several decades now, to prevent high-income parents from avoiding their own higher tax rates by simply shifting unearned income, things like dividends, interest, rents, royalties, capital gains, over to their dependent children who might otherwise be in a 0% or 10% tax bracket. Essentially, Congress didn't want parents putting, say, a large portfolio of dividend stocks in their 5-year-old's name just to get a significant tax break on that investment income.
Makes sense. So who exactly does the kiddie tax apply to? Is it just young children?
It applies to a dependent child who meets certain criteria at the end of the tax year. The child must be under age 18. Or the child is age 18, but their earned income from working does not provide more than half of their own support for the year. Or the child is over 18 but under age 24, is a full-time student, and their earned income does not provide more than half of their own support. So it can potentially apply even to college students up to age 24 if they are still dependents and don't have significant earned income.
Okay, so it covers a broader age range than just little kids. How does it actually work then? How is the child's unearned income taxed under this rule?
It sounds like it's not as simple as just using the child's own lower tax rate on all their investment income. Precisely. The core mechanism is this. The child's net unearned income is taxed at the parent's marginal tax rate, not the child's. So how do you figure out the net unearned income? You take the child's total unearned income for the year, dividends, interest, etc. Then you subtract a specific threshold amount, which for 2023 was $2,500. This $2,500 threshold effectively works like this. The first $1,250 of the child's unearned income is generally sheltered from tax by the child's own standard deduction if they have no earned income, so tax-free. The next $250 of unearned income from $251 up to $2,500 is taxed at the child's own regular income tax rate, which is usually a low rate, like 10%. Any unearned income over that $2,500 total threshold is then considered net unearned income, and that amount gets taxed using the parent's applicable marginal tax bracket, which are typically much higher.
Okay, so only the income above $2,500 gets hit with the parent's rate.
Exactly. It's only the excess above that threshold. Oh, and there's an option where parents may elect to include the child's unearned income directly on their own tax return rather than filing a separate return for the child. This is allowed only if the child's income is between $12,050 and $12,500 and consists solely of interest, dividends, and capital gains distributions. This can sometimes simplify filing, but the result is the same, that income gets taxed at the parent's rate anyway.
Got it. Let's look at Max, who is 15. How does the kiddie tax impact his $5,000 of bond interest income?
Okay, Max is 15, clearly under 18, and let's assume he's a dependent. He has $5,000 in corporate bond interest income, which is definitely unearned income. Let's say Max is otherwise in the 10% tax bracket, but his parents are in the 22% marginal tax bracket. Here, his $5,000 of interest is taxed. The first $12,250 is effectively tax-free, covered by a standard deduction, taxed at $2. The next $12,050, from $12,051 to $2,500, is taxed at its 10% rate, taxed $125. The remaining amount, which is $2,500, $5,000 total minus the $2,500 threshold, is his net unearned income. This $2,500 is taxed at his parents' 22% rate. Tax equals $550. So Max's total federal income tax liability on his $5,000 of interest is $675 plus $125 plus $550. This clearly illustrates that even though the bonds might be legally in Max's name, a significant portion of the income they generate, $2,500 in this case, is still taxed at his parents' higher rates due to the kiddie tax. It's a vital consideration for families planning college savings or other investments for their children, as it directly impacts the actual after-tax return they'll see on those investments.
That's a really important point for parents listening. Okay, remember way back when we talked about incentive stock options, ISOs, and how exercising them could trigger something called AMT, the alternative minimum tax. Let's dive a little deeper into what this minimum tax actually means. It sounds like a whole separate tax system running in parallel.
That's a pretty good way to think about it, actually. The Alternative Minimum Tax, AMT system, was originally implemented way back in 1969 to ensure that individual taxpayers, particularly those with very high incomes, who are skillfully using various tax breaks, deductions, and exclusions allowed under the regular tax code, still paid at least some minimum amount of federal income tax. It arose from a public outcry when it was revealed that a number of very wealthy individuals had legally paid zero federal income tax in certain years.
It's like a backstop tax system.
Exactly, it's a backstop. Essentially, you or your tax software perform an alternative, parallel tax calculation using a different definition of income and allowing fewer deductions. If that AMT calculation results in a higher tax liability than your regular tax calculation, you have to pay the difference as AMT. The whole idea behind the AMT is to arrive at a figure called Alternative Minimum Taxable Income, or AMTI. AMTI is designed to more closely reflect your true economic income by disallowing or significantly limiting certain deductions and exclusions that are perfectly fine under the regular tax system.
Okay, so how is this AMTI actually calculated? What are the specific adjustments and tax preference items that make the AMT calculation so different from our regular taxable income calculation?
Calculating AMTI starts with your regular taxable income from your Form 1040. Then you make a series of specific modifications. you add or subtract certain adjustments. These are items where the tax treatment for AMT purposes simply differs from the regular tax treatment. Some are timing differences, meaning the income or deduction is recognized at a different time for AMT than for regular tax. For example, depreciation on certain assets might be calculated using a slower method for AMT, meaning less deduction up front. Passive activity losses are often limited differently and added back for AMT. Net operating losses have to be recomputed under AMT rules. Crucially, some items that are perfectly valid deductions for regular tax are completely disallowed for AMT purposes, meaning they are added back to your income, increasing your AMTI. The most common and often surprising ones here are state and local taxes, SALT, that you deducted as an itemized deduction. The entire amount is added back for AMT. The standard deduction, if you claimed it instead of itemizing, that's also added back. And as we discussed with ISOs, the bargain element on the exercise of an incentive stock option is a specific adjustment item added back for AMT in the year of exercise.
Wow, adding back SALT and the standard deduction seems like it could push a lot of people into AMT territory, not just the super rich.
It absolutely can, especially for people living in high-tax states or those with moderately high incomes who take the standard deduction. Then, on top of the adjustments, you add back tax preference items. Unlike adjustments, which can sometimes decrease AMTI, though usually increase it, preference items always increase AMTI. By definition, they are always add-backs. Common tax preference items include tax-exempt interest income from certain private activity municipal bonds. These are specific types of muni bonds issued for non-governmental projects. Interest from regular government muni bonds is usually okay for AMT. The percentage depletion deduction claimed for natural resources, but only the amount that exceeds the adjusted basis of the property. Certain accelerated depreciation claimed on property placed in service before 1987. Less common now.
So why are these specific items targeted as adjustments or preferences? What's the logic?
The logic generally falls into two camps. Some items, like depreciation differences, represent timing differences. The AMT system is essentially saying, we think you should recognize that income sooner or take that deduction slower than the regular tax system allows. Other items, like the SALT deduction add-back or the private activity bond interest, are benefits allowed under the regular tax system that Congress decided, for purposes of this minimum tax calculation, were being too heavily utilized by higher income earners to reduce their overall tax burden, so they're disallowed or treated differently under the AMT rules. Understanding which of your income items or deductions are potential AMT triggers is really key to avoiding unpleasant tax surprises.
Definitely good to know. Okay, one last crucial area. Avoiding penalties. Even if you're a tax planning guru, accurately calculating everything, just missing a payment deadline or significantly underpaying your taxes throughout the year can lead to frustrating penalties from the IRS. Let's make sure our listeners know how to avoid those because nobody wants to give the IRS extra money just for messing up the timing. We're talking about estimated tax payments and underpayment penalties.
Yes, this is a critical compliance area, and it often catches people off guard, especially those who are newly self-employed, have significant investment income, or experience large capital gains without adjusting their withholdings. The general rule is, if you expect to owe $1,000 or more in federal income tax for the year when you file your return, you're generally required to pay estimated taxes throughout the year as your income is earned or received. This requirement exists because the U.S. tax system is pay-as-you-go. If your income isn't subject to sufficient withholding, like wages are, you're responsible for sending estimated payments yourself.
And these payments are due quarterly, right? What are those deadlines?
That's right. The tax year is divided into 4 payment periods, and the estimated tax payments have specific due dates. For income earned January 1st to March 31st, the payment is due April 15th. For income earned April 1st to May 31st, the payment is due June 15th. For income earned June 1st to August 31st, the payment is due September 15th. And for income earned September 1st to December 31st, the final payment is due January 15th of the following year. Note that the periods aren't equal length. And importantly, penalties for underpayment can be assessed if you don't pay enough tax by each of these specific due dates, even if you catch up later in the year. The IRS wants timely payments. Okay, timely payments are key. But how can a listener ensure they avoid that dreaded underpayment penalty, especially if their income fluctuates wildly throughout the year, or they have an unexpected large gain late in the year? What are the safe harbor rules people can rely on? The good news is there are clear safe harbor rules specifically designed to help taxpayers avoid the underpayment penalty, even if their income is unpredictable. You generally won't be penalized if 1. The total tax owed on your filed return, after accounting for withholdings and credits, is less than $1,000. If you owe less than $1,000, they usually don't bother with the penalty. 2, OR, and this is the most commonly used safe harbor. If, through timely estimated payments and withholding, you paid the lesser of these two amounts. 90% of the total tax liability shown in your current year's tax return. 100% of the total tax liability shown in your prior year's tax return, assuming your prior year return covered all 12 months.
Okay, 90% of current year tax OR, 100% of prior year tax. That sounds manageable. Is there a catch for higher income folks?
Yes, there's one important modification to that prior year rule. If your adjusted gross income, AGI, on your prior year's return was more than $150,000, $75,000 if married filing separately, then you must pay 110% of your prior year's tax liability to use that safe harbor, not just 100%. So for higher income earners, the prior year safe harbor requires a slightly larger payment. Also, the IRS may waive the penalty in very specific, limited circumstances, usually if the failure to pay was the direct result of casualty, disaster, unusual circumstances like a serious illness or the death of the taxpayer. But relying on these waivers is generally not a good planning strategy.
Yeah.
The key is to aim for those 90% or 100%, 110% thresholds through proactive payments or withholding adjustments.
That makes sense. And is there a separate penalty for just flat out not paying what you owe by the final tax deadline, even if you filed on time and maybe avoided the underpayment penalty throughout the year?
Yes, that's the failure to pay penalty. It's entirely separate from the underpayment penalty for not paying enough during the year. The failure to pay penalty applies if you don't pay the tax shown as due on your return by the regular due date, usually April 15th, unless extended, but the payment is still technically due April 15th. This penalty is calculated as 1/2 of 1%. 0.5% of the unpaid tax for each month or part of a month that the tax remains unpaid, up to a maximum penalty of 25% of the unpaid tax. This penalty is typically not assessed if you file an extension and pay at least 90% of the tax ultimately due by the original April 15th deadline, and then pay the remaining balance by the extended filing deadline, usually October 15th. So the key takeaway is file on time or file an extension and pay as much as you possibly can by the original due date to minimize or avoid this penalty.
Got it. Let's use Sarah Wilson, the apple orchard owner, as an example again to see how someone can effectively avoid those underpayment penalties using the safe harbors.
Okay, Sarah owns an apple orchard, so her income definitely fluctuates based on the harvest and market prices, making steady withholding difficult. She makes timely quarterly estimated tax payments throughout the year. For the year in question, let's say she paid estimated taxes totaling $23,500 by the January 15th deadline. When she finally filed her complete tax return in April, her actual total tax liability calculated out to be $25,000. This means she still owed an additional $1,500 with her return. Now, despite owing more money when she filed, Sarah is not subject to any underpayment penalties for the year. Why?
Because she met one of the safe harbors?
It's exactly. She met the 90% safe harbor rule. Her total current year tax liability was $25,000. 90% of that is $22,500. $25,000 by $0.90. Since she had already paid $23,500 through her timely estimated payments, which is more than the required $22,500 threshold, she is safe from the penalty. This perfectly illustrates how paying enough throughout the year based on one of the safe harbors, even if you still have a balance due when you file, can save you from those unexpected and frustrating penalties and the interest that comes with them. It's all about meeting that minimum payment threshold proactively.
That's a great practical example. Okay, wow, we have covered a lot of ground today. We've gone from the nitty-gritty details of equity compensation to the strategic timing of income and deductions, the fantastic advantages of accounts like HSAs, maximizing your standard or itemized deductions, navigating special situations like working abroad or the kiddie tax, and finally, the critical importance of avoiding those pesky penalties. So, what does this all mean when you put it together? It feels like the real magic, the real power happens when you start bringing these seemingly disparate strategies together into one comprehensive, holistic tax plan.
You've hit the nail on the head. Tax planning isn't about just finding one single trick or loophole. It's not a one-time event you do just before filing your return.
Yeah.
It's really a dynamic, ongoing process that you should ideally revisit at least annually or whenever significant changes occur. It's profoundly influenced, of course, by changes in tax law that Congress might enact. But perhaps even more so, it's driven by your personal life events and financial situation. Things like changes in your filing status, getting married, divorced, becoming widowed, having children or children leaving the nest, buying or selling a home, changing employment or starting a business, inheriting money, planning for retirement, even pursuing higher education. All of these create new planning opportunities and necessitate a fresh look at your overall strategy.
And the goal is always the same, right?
The overarching goal is always to legally reduce your taxable income or maximize your available tax credits. And you achieve this through the strategic timing of income or expenses by taking full advantage of tax-advantaged accounts like HSAs or retirement plans, by structuring transactions thoughtfully, and generally by leveraging the intricacies of the tax code to your benefit, rather than letting them work against you.
Okay, let's really pull it all together now with a comprehensive example. Let's use Rob Johnson. This will be our capstone, showing how all these different pieces we've discussed can fit together into a cohesive, actionable tax strategy that saves real money. Tell us about Rob's situation and what he was initially concerned about.
Right, Rob. He's 48 years old, single. He earns a good salary of $180,000 per year. Looking at his potential deductions, he currently has about $13,750 in existing itemized deductions, think mortgage interest, state taxes, that sort of thing. Throughout the year, $32,000 has been withheld from his paychecks for federal income tax. We also know his prior year's total tax liability was $31,516. We'll need that for penalty calculations. Now, Rob is contemplating selling some employer stock later this year. He acquired this stock through an incentive stock option, so about 3 years ago, and he anticipates the sale will generate a $20,000 taxable gain. He's smart enough to be worried that this large lump sum gain might trigger estimated tax requirements or underpayment penalties, since it wasn't subject to withholding. To potentially offset the tax impact and manage penalties, he's proactively thinking about making a $5,000 charitable gift before year-end and also contributing the maximum allowable amount to a health savings account, HSA, assuming he can qualify for one.
Okay, a pretty common scenario for someone with stock options and a good income. Based on everything we've talked about today, ISO holding periods, HSAs, itemizing, penalties, what are the key recommendations you'd give Rob? How can he not only reduce his overall tax liability, but also smartly manage those potential penalties from his stock sale?
Okay, based on his situation, here are the recommended actions. First, sell the employer stock obtained through the ISO. He should absolutely proceed with this. Since he acquired it 3 years ago, he has comfortably met both the 2-year after grant and 1-year after exercise holding period requirements for ISOs. This is crucial because it ensures his entire $20,000 gain will be taxed as a long-term capital gain, enjoying those preferential tax rates, likely 15% for Rob given his income, instead of being taxed at his higher ordinary income tax rate.
Good. Secure the lower rate on the gain. What's next?
Second, enroll in the High Deductible Health Plan, HDHP, offered by his employer, specifically so he can become eligible to contribute to an HSA. This is a really critical step for his plan. By enrolling in an HDHP, he can then contribute up to the 2023 maximum for individuals with self-only coverage, which was $3,850. He should make this contribution pre-tax, ideally through payroll deduction if possible, or as a deductible contribution otherwise. These pre-tax contributions will directly reduce his taxable earnings and, importantly, his adjusted gross income, AGI, leading to immediate tax savings.
Okay, HSA is key. What about his deductions and the charitable gift?
Third, he should choose to itemize his deductions this year and definitely make that $5,000 charitable gift he was considering. Why? Because his existing itemized deductions were only $13,750, which is slightly less than the standard deduction, $13,850 for a single filer. But by adding the $5,000 charitable gift, his total itemized deductions jump to $18,750, $13,750 plus $5,000. This new total is now significantly more than the standard deduction. So itemizing becomes clearly beneficial and allows him to deduct the full amount of his qualifying expenses, including the gift.
Okay, those 3 actions seem very synergistic. Let's quantify the impact. Can you clearly show us the tangible difference these actions make to Rob's overall tax liability? Let's compare his before planning picture with his after planning picture.
Absolutely. Let's run the numbers. Before implementing these recommended actions, Rob's AGI would be his $180,000 salary. He would likely take the standard deduction of $13,850. His ordinary taxable income would be $166,150, $13,850. His tax on this ordinary income using 2023 rates would be approximately $33,276. His $20,000 long-term capital gain from the stock sale would be taxed at 15%, adding another $3,000 in tax, $20,000.15. So his total income tax liability without planning would be $36,276. $33,276 plus $3,000.
Okay, $36,276 before planning. Now, what's his new tax bill after implementing the recommendations, selling the stock correctly, maxing the HSA, and bunching the charity to itemize?
All right, after implementing the planning recommendations, his $3,850 HSA contribution directly reduces his AGI down to $176,150, $180,3,850. He now itemizes his deductions, which total $18,750, the $13,750 original plus the $5,000 gift.
This reduces his ordinary taxable income significantly further, down to $157,450, AGI $18,750 itemized deductions. The tax on this lower ordinary income drops to approximately $31,176. His long-term capital gain tax on the stock sale remains the same at $3,000. Therefore, his new total income tax liability with planning is $34,176, $31,176 plus $3,000. By implementing these smart, proactive strategies, specifically leveraging the HSA deduction and timing the charitable gift to enable itemizing, Rob reduces his total federal tax liability by a significant $2,100. That's the difference between $36,276 without planning and $34,176 with planning. That's $2,100 that stays directly in his bank account instead of going to the IRS, simply through strategic planning.
That's fantastic. But crucially, what about his initial concern, those estimated tax payments and potential penalties triggered by the stock sale? How does this planning affect that situation? This is where many people get caught, even if they save tax overall.
This is where the planning provides a double benefit, not just tax savings, but also penalty avoidance and peace of mind. Remember, to avoid an underpayment penalty, Rob needs to have paid the lesser of 90% of his current year's tax, or, because his prior year AGI was over $150K, 110% of his prior year's tax. His prior year tax was $31,516, so 110% of that is $34,668. That's his prior year safe harbor amount.
Okay, so without the planning first, what would Rob's penalty situation look like? Would his $32,000 withholding have been enough?
Let's check. Without planning, Rob's estimated total tax for the current year would have been $36,276. 90% of that current year tax is $32,648. $36,276 for $0.990. The lesser of the two safe harbors is $32,648, 90% of current, compared to $34,668, 110% of prior. So he needed to have paid at least $32,648. Since his current withholdings were only $32,000, which is less than the required $32,648, he would have faced an underpayment penalty if he didn't take action. He would have needed to make an additional estimated tax payment of at least $648, $32,648 by the January 15th deadline to avoid it. That's an unexpected hassle and potential cost at year-end.
Right, exactly the situation he wanted to avoid. But now, with the planning strategy successfully implemented, how does his penalty situation change?
Now, with the recommended planning strategies in place, Rob's reduced current year total tax liability is $34,176. 90% of that reduced current year tax is now only $30,758 times. $34,176.90. The 110% of prior year tax safe harbor is still $34,668 times. The lesser of these two safe harbor amounts is now $30,758 times. Since Rob's current year withholdings of $32,000 are greater than the $30,758 times for minimum required payment, Rob will not need to pay any additional estimated tax payments, nor will he be subject to an underpayment penalty. The planning not only saves him $2,100 in actual taxes, but also completely eliminated the need for a last-minute estimated payment and saved him from any penalties. It's a fantastic holistic win that demonstrates the true power of integrated tax planning. You know, what's truly fascinating when you step back and look at all this is how these seemingly disparate pieces of the tax code rules about stock options, timing rules, specific accounts like HSAs, deduction strategies, when you understand them and leverage them together, they really create a powerful engine for your overall financial well-being. Tax planning isn't just about, filling out forms correctly to file a return once a year. It really should be an ongoing strategic conversation you're having with your money, one that empowers you to keep more of what you earn and ultimately build a stronger, more secure financial future.
That's a great way to put it. So, listening today, what stands out to YU from this deep dive? Is there one strategy, maybe one small change you might think about making to better manage your taxes next year? We really hope this deep dive has given you a shortcut to being better informed, equipped you with some surprising facts maybe you didn't know, and ultimately left you feeling ready to take more control of your financial future. Until next time on the deep dive, keep digging for those valuable nuggets of knowledge.